State income taxes didn't just appear overnight. They evolved out of necessity, shaped by economic shifts, political fights, and changing public needs. In the early days, states ran on property taxes. That was the primary way governments funded schools, roads, and local services. But as populations grew and economies modernized, relying solely on property taxes wasn't cutting it. States needed more revenue, and the idea of taxing income started gaining traction. Wisconsin was ahead of the curve, becoming the first state to implement an income tax in 1911. At that point, the federal government didn't even have one. But when the 16th Amendment was ratified in 1913, giving Congress the power to tax income, other states started paying attention. As the Great Depression hit in the 1930s, property tax revenues took a nosedive. Many states turned to income taxes as a way to stabilize their finances. This is why the 1930s saw the biggest wave of states adopting income taxes. By the mid-20th century, state income taxes were the norm. Today, 41 states tax personal income in some form, but they don't all do it the same way. Some states have a flat tax, meaning everyone pays the same rate regardless of earnings. Others use a graduated system, taxing higher earners at a higher rate. And then there are the holdouts, the states that never adopted a traditional income tax. Texas, Florida, Nevada, South Dakota, Washington, Wyoming, and Alaska have always operated without one. Alaska briefly had an income tax but repealed it in 1979, making it the only state to do away with it entirely. The big question is, how do these no-income tax states make up for that missing revenue? The answer is simple. They shift the burden elsewhere. States without an income tax usually have higher sales taxes, higher property taxes, or big industries, like tourism or oil, that bring in money. Florida, for example, benefits massively from its tourism industry, while Alaska generates revenue from oil and mineral extraction. Texas relies on high property taxes and hefty sales tax rates. When states first introduced income taxes, reactions were mixed. Some saw it as a necessary step to fund essential services, while others viewed it as government overreach. In the early 1900s, tax collection was far less automated than today. Many states relied on manual record-keeping, with taxpayers submitting paper forms and local tax offices processing them. Enforcement was also a challenge. Some states struggled to track income accurately, leading to loopholes and tax evasion. Over the years, debates over state income taxes have grown more intense. Some argue that income taxes are necessary to fund essential services like schools and infrastructure. Others say they push businesses and wealthy residents to relocate to lower tax states, hurting local economies. Kansas famously attempted to eliminate its income tax in the 2010s under Governor Sam Brownback's administration, but the plan led to massive budget deficits and was largely reversed. Several states are currently considering getting rid of their income taxes entirely. Mississippi and Iowa have explored ways to phase them out. Meanwhile, Tennessee and New Hampshire have nearly eliminated theirs, taxing only interest and dividend income instead of wages. Every time a state debates cutting income taxes, the same concerns come up. How will they replace the lost revenue? Will other taxes go up? Will public services suffer? State income taxes aren't static. They shift with economic pressures, political movements, and budget demands. Some states raise rates during financial crises. Others cut taxes to attract businesses. With growing conversations around tax reform and economic competition, the future of state income taxes is anything but settled. Will more states follow Alaska's lead and eliminate theirs? Or will the reliance on income tax remain a key part of state budgets? That's the big question moving forward. If you want clear myth-busting tax insights, hit subscribe. Thanks for watching. I'll see you next time.